What if I told you that right now, in real time, one of the most widely traded stocks on Wall Street just delivered its single best operational weekend of the entire year, and somehow the stock is still down nearly 45% from its recent peak? I want you to sit with that for a second. The theaters are completely packed. The popcorn is flying off the shelves. The numbers are honestly historic. And yet the chart looks like someone drove a truck off a cliff. Welcome back to Smart Stock Sam, the channel where we cut through the noise, decode what the data is actually screaming at us, and help you trade and invest smarter than the crowd. And today, we are diving deep into one of the most confusing, most misunderstood, and honestly most compelling setups in the market right now. We are talking about AMC Entertainment. If you have seen our title and you are here right now, you already know something big is happening. And what we are about to unpack is a hidden clause buried inside AMC's most recent SEC filing, a convergence of institutional money moving in quietly, and a technical structure that most retail traders are completely overlooking because they are too busy panicking. So do not go anywhere, because if you are holding this stock, or even if you are just watching it from the sidelines, what this data is telling us right now could completely change the way you see this trade. Let us get into it. To truly understand where this stock is heading, we need to go back and understand exactly what broke in the first place, because without that foundation, nothing else makes sense. Just a few days before the close of last week, the blueprint for an explosive move was fully assembled and locked in. Before the opening bell on June 22nd, we had a massive buildup of call options sitting at the $2.50 and $3 strike prices. And this was not random retail speculation. This was a mathematical and mechanical reality. Those stacked call options created what traders call a gamma magnet, a gravitational force that would have compelled market makers to automatically purchase millions upon millions of shares simply to hedge their own risk exposure. The stock had built a concrete, well-tested floor at $2.50. The path toward $3 looked clean. The fuel was loaded, the engine was primed, everything pointed to a breakout. But then, management did something that nobody in the retail camp saw coming. They leveraged the exact upward price momentum that traders had spent weeks building, and they used it to announce a $200 million registered direct offering. 95.25 million brand new shares, sold directly to institutional investors at just $2.10 per share. That price represented a brutal 24% discount to where the stock had been trading the day before. And when that news hit, it triggered an immediate and absolutely vicious supply shock to the market. If you pull up the chart and zoom into the anatomy of what happened next, the damage is unmistakable. Those massive call option stacks that were supposed to act as rocket fuel, they got completely neutralized. The wrecking ball of 95 million new shares obliterated the $2.50 support floor. That level did not crack. It did not hold for a few hours and then recover. It collapsed entirely. The stock closed at $2.08 on June 23rd, representing a 24.6% crash in a single session. Retail holders who had been sitting on gains from the breakout setup got completely drowned in dilution. The gamma squeeze was suffocated before it ever got the chance to ignite. And most people watching from the outside looked at that carnage and walked away. But here is where this story gets genuinely interesting, because walking away right now might be exactly the wrong move. Here is what has fundamentally changed in this thesis. Yes, the technical squeeze was derailed. Yes, the breakout was aborted by management. But paradoxically, and I want you to really hear this, the corporate balance sheet coming out of this offering is exponentially stronger than it was the week before. We are no longer analyzing a pure high-octane gamma squeeze play with a constant daily threat of share dilution hanging over every price spike like a guillotine. The thesis has now recalibrated into something potentially more powerful and far more durable, what I would call a de-risked fundamental turnaround. The dilution overhang that crushed every previous rally? We have traded that for a locked float. The old floor at $2.50 was shattered, yes, But we have landed squarely on top of a far more structurally significant safety net, and that net has a very specific address on the chart, which we will get to in just a moment. First, let us talk about what management actually did with that $200 million. Because this is where the real thesis lives. They did not sit on it. They did not park it in a money market account. They deployed it with surgical precision directly against the primary weapon in every short seller's arsenal. Management took $189 million of those net proceeds and executed a targeted elimination of their 6.125% senior subordinated notes due in 2027. In plain language, they wiped out a massive tranche of high-interest, near-term debt in a single move. Now ask yourself this: what is the absolute core of any short seller's thesis against AMC? It is the looming threat of bankruptcy. It is the argument that this company cannot survive its own debt load. By taking that specific tranche of debt completely off the table, management has not just improved the balance sheet. They have directly attacked the foundational argument of every short seller in this name. You take away bankruptcy risk, you take away the short thesis. It is that simple. And they did not stop there, because buried inside the fine print of this offering's SEC filing is a detail that changes the entire trading timeline for this stock, and most people completely missed it. As a condition of the $200 million offering, AMC management agreed to a restrictive covenant, a 45-day dilution ceasefire. For the next month and a half, they are legally locked out from issuing or registering new shares of equity, with only very narrow and limited exceptions carved in. Now think about what this means for a moment. The single biggest reason retail momentum in this stock has been repeatedly strangled, the fear that every single price spike will be met immediately by management dumping new shares onto the market. That fear is now legally suspended. For 45 days, any upward price momentum can actually breathe. It cannot be immediately suffocated by another equity raise. This is not speculation. This is not hope. This is a contractual obligation baked directly into the SEC filing. And for swing traders operating in this window, that distinction matters enormously. So we now have a dramatically improved balance sheet, a legally binding freeze on new dilution, and a recalibrated technical setup with structural support at $1.87, right where the 200-day moving average currently lives. But none of this matters at all if the underlying business is crumbling. So let us look at what the actual theaters are telling us. Because here is where the operational divergence becomes almost surreal. While the stock chart was bleeding out, AMC's theaters were delivering what can only be described as a historic performance. Driven by the massive release of Toy Story 5, AMC just posted a $160 million domestic opening weekend. This was not just a solid box office weekend, it was the single busiest American movie-going weekend of all of 2026, bringing 4.8 million people through AMC's doors. They shattered their full-year 2026 records for attendance, and they did it in a single weekend. But the number that really matters for their actual profitability? Food and beverage revenues also hit 2026 records, with per-patron spending climbing 4.5% to $8.43. That concession line is not just getting busier, it is generating premium, high-margin revenue per head. And that is exactly the kind of metric that moves the needle on actual earnings. And here is the question you need to be asking yourself right now. What are the odds that this is the last blockbuster of the summer? Because the answer is essentially zero. Looking at the next 6 weeks alone, AMC's theaters are going to be fed a continuous, relentless parade of guaranteed crowd pullers. Supergirl lands in late June, then Minions and Monsters, then Moana, and capping off July, the one film that could genuinely redefine what a summer blockbuster looks like in 2026, Spider-Man: Brand New Day. But beyond just the film slate, the macro environment is finally cooperating in ways that have not aligned in years. Softening inflation data means consumers are holding more disposable income for discretionary entertainment, and the structural tailwind that could define the next several years for theatrical exhibition. The finalization of the Paramount and Warner merger has brought with it a contractual guarantee of a minimum of 30 major studio films released theatrically each year, with fully restored 45-day exclusive theatrical windows. Streaming is no longer eating the box office alive. The theatrical window is back, and AMC sits right at the center of it. Now, given everything we have just laid out, a fortified balance sheet, a ceasefire on dilution, and a record-breaking operational environment, you might be wondering who else sees this. Because if the story is this compelling, surely the smart money is paying attention. And the answer is yes. But not in the way most people would expect. What we are seeing right now is a massive institutional rotation playing out almost completely under the radar. Passive index funds and large retail-heavy positions, names like Vanguard, have been reducing their exposure as the stock has sold off. But look at who has been standing on the other side of that trade, quietly and methodically absorbing those shares. Renaissance Technologies, RBC, BlackRock. These are not emotional retail traders chasing a meme. These are algorithmic, research-driven institutional titans that do not move nine-figure sums without an extremely thorough thesis. They are accumulating, not selling, and that signal should not be dismissed. The conviction deepens further when you look at how the actual $200 million capital raise was structured. This was a registered direct offering, meaning those 95.25 million new shares were not scattered blindly across the open market. Sophisticated institutional investors voluntarily chose to purchase them directly at a fixed price of $2.10. When institutions are willing to inject nine figures into a company at a set price, they are making a loud, deliberate statement about the structural viability of that business at that valuation. That $2.10 level now carries the weight of a heavily defended institutional cost basis. And on a more personal level of conviction, CEO Adam Aron previously put his own money directly on the line with a 250,000 share open market purchase, defending the $1.38 level. That is a signal you cannot manufacture. Yet despite all of this, the institutional accumulation, the insider buying, the balance sheet transformation, the record box office numbers, Wall Street's analyst community is still, stubbornly and predictably, trailing the real-time data. Legacy bearish voices like Citigroup are still clinging to a sell rating with a price target of $1.20. The broad consensus on the street is clustered in hold territory, with targets ranging from $1.68 to $2.13. But cracks are forming in that bearish wall. B. Riley has already upgraded their target from $2 to $2.25. Benchmark has taken the bigger step and fully flipped to a buy rating with a $2.50 target. And notice where that $2.50 target keeps appearing. It is the exact same level that served as the mechanical ceiling in the original gamma squeeze setup. The smart analyst money is quietly mapping right back to that critical resistance zone. Let us now bring all of this into the technical dashboard, because when you overlay the fundamentals with the chart structure, the picture becomes genuinely striking. Right now, every short-term momentum signal is screaming oversold. The 14-day RSI sits at 30.29, well into deeply oversold territory. The Williams %R is buried at negative 84.9. The 5-day, 10-day, 20-day, and 50-day moving averages are all flashing red sell signals simultaneously. The algorithms are blindly hammering the sell button in reaction to the price drop, without any consideration for what the underlying business is actually doing. But pull the lens back, zoom out from the noise, and look at the structural chart. And what you see is the 200-day moving average sitting squarely at $1.87. Right now, bouncing off that level, it is generating what technicians would call a textbook buy signal from a long-term structural support zone. And here is where the complacency trap becomes extremely dangerous for the other side of this trade. There are currently 59.08 million shares sold short in AMC. That is a massive short position by any measure. But here is the critical detail that makes this setup asymmetric. The borrow fee to maintain those short positions is a microscopic 0.49% annually. It costs almost nothing to stay short, and when it costs almost nothing to hold a position, you breed complacency. Short sellers feel no urgency to cover. They feel no pressure. They are sitting back and watching, comfortable in the assumption that nothing can shake them out. But sitting directly across from them is the options engine. Looking ahead to the July 17th options expiration, traders have stacked over 64,000 call contracts at the $2 strike, and another 30,000 contracts at the $2.50 strike. If buyers can step up and defend that $2 level and hold it, the sheer mechanical weight of those contracts has the potential to restart the gamma engine violently and without warning. The complacent shorts would be caught completely flat-footed, and that is exactly the kind of asymmetric setup that creates the most explosive short-term moves in the market. So, what does all of this mean for your actual portfolio? How do you position yourself in this without taking on unnecessary and reckless risk? Let me be crystal clear about this, because it matters. Given the structural damage from the $200 million offering, this is a setup for high-risk momentum and swing traders. This is not a retirement account holding. This is not a passive investment. This requires active risk management and full awareness of the volatility involved. With that said, the framework here is straightforward. The ideal entry zone is as close to the institutional offering price of $2.10 and the psychological $2 floor as possible. Your structural safety net, the level where the entire thesis rests, is the 200-day moving average at $1.87. If price closes convincingly below $1.85, that is your hard stop. No hesitation, no rationalizing, no averaging down. If that moving average breaks, the thesis is fully invalidated, and you exit. But if that floor holds and buyers begin to defend the $2 options strike, the near-term resistance targets are a retest of the $2.50 former support zone, followed by a potential gap fill back to pre-offering levels around $2.83. When you bring all of these layers together, the fortified balance sheet, the 45-day dilution ceasefire, the record-shattering box office performance, the institutional accumulation at the $2.10 level, the deeply oversold technical readings, bouncing off 200-day moving average support, and 64,000 call contracts lined up at the $2 strike E, the picture that emerges is what I call the coiled spring setup. The offering caused real, undeniable price pain, but it also dramatically strengthened the machine underneath. If buyers defend that critical $2 level within this legally protected, dilution-free 45-day window, AMC has every mechanical ingredient required to trap complacent short sellers and drive a violent move back toward the $2.50 resistance. The machine was broken last Tuesday, but the engine has already been rebuilt. Before we wrap up, I want to be very clear about something important. Everything discussed in this video is strictly for educational and informational purposes only. None of this constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Investing and trading in stocks, especially in high volatility names like AMC, carries substantial risk, including the possible loss of your entire principal. Always conduct your own due diligence, consult with a qualified financial professional before making any investment decisions, and never risk capital you cannot afford to lose. Past performance and historical chart patterns do not guarantee future results. Smart Stock. SAM is an educational channel, not a financial advisory service. Now, here's the question I want you to think deeply about and drop in the comments below. If AMC successfully defends the $2 level through this 45-day ceasefire window and the gamma engine restarts, do you think the short sellers cover in time, or do we get a full mechanical squeeze before they react? I want to read every single response because the community's thinking on this is genuinely valuable. If this video gave you a new lens on this trade, smash that like button right now. It takes 2 seconds, and it tells the algorithm that this analysis deserves to reach more investors who need it. And if you are not subscribed to Smart Stock SAM yet, what are you waiting for? Hit subscribe and turn on notifications so you never miss a breakdown like this one. We are in the markets every single week, decoding setups before they move. And here is something that truly moves this channel forward. If this content has added real value to your investing or trading, consider sending a super thanks right here on YouTube using the support button below this video. Every single one of those goes directly back into producing deeper research, better charts, and higher quality content for this community. Your support is what makes this channel possible, and it means more than I can say. Finally, if you are serious about leveling up your investing and trading, not just consuming content, but actually developing the skills and the mindset to trade more intelligently, I want to personally invite you to join the Smart Stock SAM exclusive membership community. Members get access to deeper analysis, direct community engagement, and early access to content before it goes public. The link to join is right below this video. Come be part of a community of investors who are choosing to think differently, trade smarter, and grow together. I will see you inside, and I will see you in the next one.